Okay, so when we're talking about the product cost for the absorption system, that is also known as the traditional way to allocate your product cost. So anything that goes into the making of your product, your materials, your labor, and all of your overhead is allocated to the per unit cost. Absorption is also known as the traditional method. Variable will only take the variable items. We know the definition of a variable cost is that the per unit cost on those items will stay consistent, will stay the same as the activity increases or decreases, but the total would change. So materials is always variable, labor is always variable, and there is a portion of our overhead that is always considered variable. So the way it will look when we compare the two costing systems on a per unit basis is like this. On my overhead on my whiteboard here, I know I'm so technologically advanced, you can see that I have written out product cost. So the product cost variable would include material, labor, and variable overhead, but it's not going to have a portion of the fixed overhead allocated to it. So I'm going to write this all out for you as I talk through it. Let me grab my handy dandy markers. And red for absorption. So we'll compare and contrast the per unit cost. The first thing I want to talk about, though, is that what you will see, the main difference between these two costing systems is how the fixed overhead is treated. So the total fixed overhead will be allocated on a per unit basis to the absorption, to the product on the absorption. So what I've written here is, let's pretend that we are a marker manufacturer. We produce and sell markers. And these markers have some kind of special quality, like the more you smell them, the smarter you become, right? Or maybe the more you smell them, the stronger you become, or the skinnier you become, whatever you want. That's what happens when you smell it, right? So these markers are going to cost a little bit for us to make, and we're going to sell them for a little bit more than normal priced marker. But the material cost on these markers would be allocated on a per unit basis right here. So we're going to say that our per unit material cost is $6. Then we're going to say that the per unit labor cost is $5 and the per unit variable overhead cost is $1. Let's see if you can see that better with the lighting. This fixed overhead cost is $430,000 for the whole year. $430,000 for the whole year. If I want to put that in a per unit, I need to divide by the number of units that have been produced. When I divide by 125, you'll see that that comes out to $3.44 per unit. The fixed man overhead is added to the per unit cost when I'm dealing with absorption, when I'm dealing with the traditional costing method. That says any cost incurred to create my product gets added to the value of the product, gets included in the per unit cost. So I'm going to add these up. It looks like it's $15.44. But when you're dealing with variable, those per units are only going to be the variable items. So it's going to say that when I allocate my material cost, that definitely is a variable cost, and my labor is a variable cost, and my variable overhead is the only portion that would be added to this per unit cost. So the variable costing method will always produce a lower per unit. This one was $15.44 with absorption with the traditional costing method. The variable costing method is only $12 per unit. So that's the main difference. So if we took all of the units that we had produced, 125,000, and remember these markers are very special. We're going to sell each of them for $20 a piece. So if we took the 125 that we produced, 125,000 units, and multiplied it by the sales price per unit, give us our total revenue of $2,500,000. Now your variable income statement always segments your cost into variable cost at the top and fixed expenses at the bottom. So cost of goods sold is always variable. We will take that initial $12 per unit that we calculated previously on the product cost. The per unit variable product cost includes materials, labor, and variable overhead. So we're going to take the 125,000 units and multiply it by the per unit product cost that you have to calculate. And we're going to find out your cost of goods sold is $1.5 million. Then at the top, we also want to list any variable selling and variable admin cost. So it will tell you in the problem what the per unit variable selling cost is and the per unit admin cost is. I will multiply that by the number of units I have sold. I sold 125,000 units multiplied by 80 cents per unit. That's $100,000. 125 multiplied by 40 cents per unit. That's $50,000. Do you remember what it's called when you take all of these variable costs and subtract it from the sales? Oh, contribution margin. Good. I know a couple of you remembered that. Sales minus variable cost. So when I take 2.5, subtract off 1.5, I'm looking at $1 million minus 150,000. My contribution margin is $850. If I told you the selling cost were $300,000 and the admin was $120 fixed, right? The fixed costs don't change depending upon the number of units sold or produced. Those fixed costs don't change. So those are going to be given in the problem. The selling and admin fixed would be given. Now this fixed manufacturing overhead I already mentioned on the prior calculation of the per unit cost. It is $430,000. We are expensing it in its entirety when we are using the variable costing system. So if I take these three fixed costs and I subtract it from the contribution margin, it looks like they're right at even. They have zero net income. $850,000 was my contribution margin minus these three fixed costs that would be given in your problem. That will give me the total net operating income. That's the variable costing system. Now, companies don't flip-flop between this. They have to follow the absorption costing method because it is GAAP approved. It is the one you have traditionally learned, where you take sales minus cost of goods sold, which gives you the, come on, who knows it? Maybe Josh knows it. Josh says gross margin. Yes, that is right. So sales, still 125,000 units times $20 per unit per marker. That's what we're charging our customers. $2.5 million. The cost of goods sold, remember, was $1,344 because it included the fixed manufacturing overhead in the per unit cost. So when I multiply that by 125, I got $1,930,000. When I subtract that off of here, looks like my gross margin is $570,000. Now, the way this income statement is segmented is the only thing it puts on the top is cost of goods sold. At the bottom, it lists all of the selling, the period cost and administrative cost, right? So the selling costs, remember, were 80 cents per unit. That was $100,000 plus the fixed component. Now, on the prior income statement, we put the fixed at the bottom and the variable at the top. It's not going to change the numbers, though. The variable was 100,000. If you flip back through the video, you'll see 100,000 was listed up at the top as a variable selling cost. Right now, I'm just taking that variable selling cost of 80 cents per unit multiplied by 125, 100,000, and adding it with the fixed. And I'm just putting the total selling cost down here. And then I'm going to do the same thing on the admin. It was 125,000 units at 40 cents per unit, plus my fixed portion. This was $50,000. So when I add in the 50 to the fixed 120, I have 170 there. So when I take this gross margin and subtract the variable or the selling and administrative cost, guess what? Whoever guessed that the net incomes would be the same was correct. Maybe it was, I don't know, Bryce might have guessed that they would be the same. Okay, so one twist. We're going to change the scenario a tiny bit. So Tanner comes in and he says, I can make your business profitable. He says, Ethan is the manager. He says, all you have to do is produce more units. And Ethan's like, what? Let's try it. So Tanner says, I think you should produce next year 172,000 units. So when we do that, we are going to always take, well, the next year, we're going to recalculate a per unit cost. We're going to take the total fixed man overhead, and we're going to divide it with still $430,000 by more units. Remember last time it was $3.44 per unit, but now Tanner says, produce more units, build it, and they will come. And he says, if you have a profit, guess what? I want 20% of that profit. And Ethan's like, okay, sure, 20%, no problem. So when you produce more units, what you do is you're reallocating that fixed man overhead cost out. You're spreading it out. Remember, fixed man overhead is a cost that in total doesn't change, but the per unit is now becoming lower. It became $2.50. So when we look at the per unit cost, it's going to say that we have $6 in material cost, we have $5 in labor cost, we have $1.50 in variable overhead, but now our fixed man overhead has just been reallocated down from $3.44 to $2.50. So it looks like each marker is only costing us $14.50 to produce, okay? Ellie says higher because she's a smart girl. So let's look at it. The sales is not going to change because we're going to say in this scenario, they didn't sell any more units. So if we take the 125 and we multiply it by, we're selling each unit for $20, we would still have revenue of $2,500,000. The cost of goods sold this time, though, remember we're working with absorption, we're working with the traditional system, is going to say 125, but this time it'll be multiplied by 1450. So when we take $125,000 and we multiply it by 1450, we should have a cost of goods sold of 1 million, let me write it down here, 1,812,500, giving us a gross margin, ooh, it's higher, of $687,500. Last time it was 570. Ooh. So what's going to happen at the bottom? Remember we list those selling and admin costs. Since we didn't produce any more units, we sold the same number of units, those two numbers won't change. If you flip back through the video, it would say there was $100,000 of variable cost and there was $300,000 of fixed selling cost. So it was a total, this is the variable and the fixed, of $400,000. The admin, if you look back at the video, it was 170 because because it was 50,000 plus 120,000. So now we have income of, let's see, what is that? $117,500. What? And all we did was produce more units. So Tanner walks away with like, what is that? $25,000. And then he puts in his 2 weeks notice and he finds a job somewhere else. So absorption costing system is the way we are supposed to allocate our cost according to GAAP. So that is fine, but there will be an issue next year because what he's done is he has taken the inventory and the cost of the fixed man overhead right here, this $430,000, and spread it out over more units. So let's go back. If this is how many units we produced, but we only sold 125,000 units, how many units are left on our shelf? Well, let's see, Tal. It's 172 minus 125, 47,000. If you take 47,000 units and you multiply it by $2.50, it should be that number right there. That's the amount of fixed man overhead that has been shoved in the asset hole. Oh, what? That's being left on your inventory. That is the fixed man overhead cost that was allocated to your inventory and not sold yet. So that created, if it's not sold yet, it didn't show up as a cost. Therefore, it looks like you have less cost this year and higher net income. Now, if you were to recreate the variable income statement, which I have all these numbers posted in an Excel spreadsheet on Canvas, if you were to look at the variable income statement, it would now show zero income for the next year because it does not manipulate this fixed man overhead cost ever as part of the assets. It always expenses the entire amount. It expenses the entire $430,000 as a period cost. Remember, it takes all the fixed costs and calls them expenses. It doesn't allocate them as part of the asset. So the variable costing matches better with what actually happens to your cash, where absorption follows your generally accepted accounting principles. So companies will use both systems. They will create their financial statements based on absorption, but they will know that the income could be inflated by leaving inventory on their shelf. So what I was going to say is the next year, when Tanner is gone, they will start using up that inventory that was left on their shelf. And what will happen is this fixed man overhead from last year will actually get released into their income statement next year, and it will make them have a lower net income. They would actually probably be in the negative next year because they had to take some of last year's fixed overhead and they had to expense it in the following year, right? To show that that inventory got sold. They wouldn't produce as many next year. They would say, whoa, whoa, whoa. Like Colton would be their inventory manager and would say, we don't need to produce that many units. Look, we have 47,000 left over from last year. So then next year, they'll produce less units, and that would cause their fixed man overhead per unit to be higher next year. And so when they sell those units, it's going to look like it cost them more, and then they're going to be in the negative. So I know you probably have questions. Hopefully you'll join me in a Zoom session or you will email me. I will try to do another shorter video working out a couple of homework problems. Good luck!